All right, so thank you everyone for joining. So this is the fourth quarter analysis of Lone Star Capital's portfolio. It was definitely an interesting quarter, challenging quarter, but still productive, fruitful, and we made it through. So jumping right in, or actually I should preface this by saying Rob is not with us today. He's actually traveling currently. He's on a plane to a conference, and that is just due to a result of us having to switch the meeting date up on short notice. So apologies, Rob is not with us. We'll keep this a little briefer than usual, and Rob sends his regards, and we'll be back for the Q1 2023 review. But so this screen here obviously looks pretty bare bones, just in terms of acquisitions, dispositions, and such. We acquired a property in West Houston, Madison at Bear Creek, closed in November, I believe November 3rd, if I'm not mistaken. But it was 180 units, a 82 vintage, and in an area or a pocket that we do like. And in terms of Q1 through 4, the actual year, it was a incredibly busy year. So it was kind of nice to end off with just this last acquisition. We were still incredibly busy with a number of other items. But during the year, just a few stats to go to throw out there. So the property that we did sell that was right in the same area where we purchased Madison at Bear Creek was Verandas at Bear Creek, and that closed with a gross IRR of 37%. It was our second sale, our second full cycle deal. Over the year, we purchased 6 properties, a total of $225 million in equity, of which we raised $72 million in equity. And our team grew as well. So we hired 2 full-time employees, 2 interns, a couple of virtual assistants, and really made a lot of progress this year. So while this looks a little sparse for the year, it was quite busy. And just to show our current portfolio where we're at, so this is Houston. Obviously, we're clustered around. We have these three properties that are not actually in the the larger Harris County area, Solano, Hollister, and Encore. And if we add in the landing at Pinewood Park, which is one of our properties that was actually under contract, that did not close, unfortunately, just due to market conditions over the quarter. That is in Lubbock, way up here, so a tertiary market. And we were looking to dispose of it just because we were able to get a great price at the time. The buyer just wasn't able to transact due to, again, market conditions or a variety of things that happened, basically. But we still hold that asset and are still bullish on it. But if we look at just the last property that we acquired, and Timberwalk as well, which we acquired in Q3, they're literally like right next door to each other. And Verandas at Bear Creek, I believe, was over here. So we like the area, and we're hoping to capitalize on some synergies here, payroll for one, and then also marketing and leasing on that side. So maybe maintenance as well, perhaps R&M. Which would come from having extra bodies around as well on payroll. But we doubled up on that area essentially. So it was very, very busy in terms of our value add business plans, which primarily all of these are. We were incredibly busy, completed a ton of work, scheduled most of our projects. For most properties, at least through, I would say, Broadstone and Timberwalk, pretty much all or most of the exterior work has been completed, so that we go in quickly and are able to knock all of that out pretty swiftly. The interior renovations, usually our stabilization period is about 24 months. Again, depending on the size of the property. But we usually do renovations at turn, and we have been for most of these. So that's responsible for the small lag there, or what takes the longest. We're thinking about possibly doing entire buildings at once, but we don't want to sacrifice occupancy, to go in and do renovations, rather kind of do a piecemeal and capitalize on it that way. But I mean, you can see here, we were able to stay under budget on a lot of these. Again, some of these numbers were just beginning, so they're not as impactful or meaningful. But one property that we took out of here was the landing, because we did wrap up that entirely last quarter, or a couple quarters ago, but took it out last quarter. And that we came in pretty much right on budget. So, we're able to adjust our business plans based on the market and what's happening. We have seen costs go up, definitely over the last few quarters. Over the last quarter, some costs have come down though, washers and dryers specifically, connections, so the work for that. And then also granite, and smart tech packages. So thermometers, locks, smart home interiors. Those are usually large budget items, and we've had to pull back on some properties, or kind of just reassess our timing of implementation, or potentially chop that out. So on Encore, for instance, we did have a plan to install granite throughout, and we had been getting the premiums on our units already without granite. So we've held that back, probably thinking that we're not going to go through with it and just leave it, and we're not being charged interest on that money because that CapEx money was held back by the lender. Speaking to that, that's great that we don't have to pay interest on the CapEx holdback. However, we have seen as the capital markets have sort of tightened up and interest rates have risen, some lenders are being a little more scrutinous of releasing draws, and just wanting to make sure that debt service coverage ratios are going to be hit, and other metrics, rather than just releasing funds willy-nilly. It seems like they're doing a little more digging, which is fine, but it is increasing the time of us receiving draws back. And so that's one thing that we've had to manage definitely over this last quarter and into this quarter as well, is the timing of draws that we're receiving, because we're able to go very, very quick on the business plans and could roll through them faster than some of the lenders have kind of allowed us. And it's just one thing that we've had to manage and deal with there. But the lenders are, understanding and working with us, and we're moving forward. But CapEx wise, very, very busy, and so far so good. So looking at P&L, this is for Broadstone. This is a property that we acquired in May of 2022, last year. So yeah, we're pretty much on track as far as income, above budget. Expenses, however, are above budget as well. And the resulting NOI down here is the net you can see. So two things to note here. The reason for this increase here, and something that we are seeing property-wide, and as we're speaking to other sponsors as well, are insurance costs. And so if you look here, we had been accruing $18,000 in insurance, and going forward, it's basically doubled. Now we have elected to take advantage of a master contract where the majority of our properties are under the contract. And so in the short term, there have been some increased costs, but we do believe that over the long run, it should save and decrease our costs insurance-wise. Taxes, however, we were able to receive a number of favorable valuations of the properties. And so, as many of you probably know, there is somewhat of a game that's played with taxes, where the property value will be contested and then usually changed, and then there'll be litigation to get it down even further, at which point the tax amount that was paid at the start of the year, you get a refund on it later in the year. And so we were able to get some very valuable and favorable tax appraisals, valuations. So that's one positive that we definitely saw. Looking at other properties, just see Hollister is a property that we've held since November. Here, this jump was largely a result of other income, an increase here. So you can see month over month, it went up 7.2%. That was due, I believe, to some new Comcast marketing contract, I believe. So, Comcast revenue. One time though, so we won't have that ongoing, but that was a great jump there. Moving on, so looking at occupancy just across our portfolio, it's definitely been a mix depending on the area. Some areas are more stable, some are kind of choppy, and we feel that it's distorted due to the eviction process and the eviction timeline. So looking at Encore, for instance, I mean, we started at 92, we've been up, down. This is a result of a number of evictions. This down here might seem like a jumble, but this is basically just by unit type. So we can see what units are favorable or most attractive, and which aren't as attractive, or what units perhaps we need to push more, obviously. So it looks like this one bedroom so the R just means that it was previously slightly renovated by the prior owner. And those are lagging behind, perhaps. I have to dig in and see, but I mean, I'm guessing they're, they prefer the renovations that we're doing on our end. And it's a bad joke, but we dig in and see what the reason for. Maybe they're just in different locations. This property does have 4 separate elevators, but maybe some folks don't want to live up higher, and those units just haven't been available. But we would look this graphic here as well. This is what we would look at too, and also dig further in. But basically, it just shows total number of move-ins, move-outs, which units those were attributed to. Again, so we can focus on what we're need to improve. And then here as well, you can see that just over these 2 months, I mean, we jumped quite a bit. This was just a result of a huge push by our on-site team. But if I go back to Solano, so you can see here, mostly we were around 92%, kind of in a holding pattern there. I mean, it changed slightly month to month, but we got up to 95% and then had a huge drop off. And this was a result of a number of evictions finally going through the judicial process and being awarded. And so, there's just a huge drop in occupancy, which you can see we're starting to pull back up. And actually, I believe as of today, we're up around almost 93%. So working to get that back up. So kudos to our on-site team there. But the eviction process is still lagging, and we're hoping that over the next quarter, 2, 3, but definitely this year, that the courts get freed up and we get back to a more usual or identifiable period, so that there's less uncertainty essentially. But whereas a eviction, the process might have taken 4 or 5 weeks from start to we have the keys again to the unit, we've been seeing it be 4 to 5 months in some cases, just because it started with COVID and not having to go to court, but there's just been a number of things happen and instances, and basically you just go in, have to file a paper or a motion to get an extension, and the process has dragged on quite a bit longer than we've historically seen. And so that's one thing that's been harder to manage, but something that we have to nonetheless. And just looking at this, this 1-by-1 bedroom, I believe this is a slightly larger size than our 1-by-1A, and this is a little more stable, and so perhaps people are just preferring that size for the value there. But one thing that we would go look at as well as we dug in deeper. And then lastly, this is Hollister. Again, there's just a number of unit types. The property is spread out over 2 different sections, but there's a mix of 2-story buildings and then townhomes, 3-story buildings. It's 2 properties that were basically combined. But here we've been, other than a slight dip to 93%, we've been quite occupied, and the property continues to stay occupied, even as we've continued to increase our market rates. So this property is just really performing well. Looking at our collections, we also have delinquency on here and historical collections. So basically these are the same visualization, but just easier to see here, and compare the total value. But pretty much for most every property, January payments came in much earlier, and we're wondering why, what the result for that was. But if you look at January, so it started out, Sunday was the 1st, 2nd, 3rd, 4th, right off the start. So perhaps, more funds came in, the onsite team was able to get these processed. Not sure entirely, but, certainly a great way to start off the year. Certainly hope it continues, that, we receive the majority of our rents right off the bat. And so I'm looking at this line here, January, but again, you can see with pretty much every property here, it was like that. January just started off with a bang. And in addition, so this is Encore again, delinquency has been going down. These were, so this growing trend here of 90% plus, this was again, evictions that were finally executed. So, I don't want to say we're happy that they went through. We certainly don't want to have to evict people, but now we're able to release those units after we renovate them and command higher premiums. But you can just see how it's taken quite a long time. And then in terms of delinquency elsewhere, wanted to say we've just been working quite hard to reduce delinquency at pretty much most of the properties. But here we like the trend specifically in the longer term delinquency, but also in the 0 to 30 category. And some of this is distorted due to housing authority funds, which we still are receiving. It's still coming in, but that's just one additional item that we're having to manage, which is the unpredictability of the timing of cash flows from rent relief programs. Looking at rents, so at our properties, this has a number of different visualizations here, but so average rents for the property across all units, just our actual rent compared to our market rent. Down here, new rents, renewal rents, and then just rent growth overall. And so this is a visualization of basically data that's on here. So you can see, what's been going on over a T3 and a month-over-month period. But as I was mentioning with Encore, so not only did those evictions take place in October, we increased our market rents in November. And you can see down here that this is across the entire property. So, well, that's important to look at. We're more interested in these two, just because they're a little more granular. And so you can see here that we're renting new apartments, new leases, right here, $50 above our market, and our market was already increased, quite a bit from the prior month, 107.9, 100 plus. So we're getting about $150 bumps on rents here. And again, this is without installing granite. So there's certainly been a lot of growth and tolerance for the increased rents. We'll see whether that continues. I know there's a lot of discussion of, pullback and such, but that does remain to be seen. But then as well on our renewal rents, we're getting, there's a $50 premium, $49.85. So as well, a premium on our renewals as well. Moving forward, so this is looking at leasing and marketing data. If we're looking at Timberwalk, so this is one of the properties, again, that I mentioned is right next to Madison and Bear Creek. So one thing that's interesting is this huge chunk here is actually drive-by. So the area does get quite a bit of traffic, and you can see down here what the what this source of lead actually translates into in terms of showings, applications, and leases. And so the drive-by has been a quite valuable source of, showings. If you look back to July, it was nearly all of them, but at least almost 50% every way, or every month, pardon me. But then the amount of actual leases that it turns into as well is a high amount also. And so this is very, very valuable, and this is where a lot of our actual leases are coming from. And so that's one thing that we're focusing on capitalizing on, is if a particular unit type is occupied or full or not available at this particular property, we're able to take advantage and say, go down the street to Madison. You love the area, you want to be here, very similar, property. That's just one additional factor that we're able to leverage and that we're hoping to capitalize on. But in addition, just building on that, walk-ins are, somewhat, looks like it's trailed off a little bit, granted. But referrals, let's see. Yeah, so this is the referral box, not a great color. We should probably update that. But we're always happy to see referrals. And if you look down here, it is turning into actual leases. And so that we're happy to see. This looks quite dramatic. And this is when all those evictions took place. But as you can see, we've started to rebound. We're up to 91.3 at the end of January. It's actually increased further. But our conversion rates, we've stayed pretty consistent, as far as NTVs. Here, actually, all NTV units renewed. And that was December. So yeah, property is performing well here also. So looking forward to Q1 2023, I mean, it's almost more than halfway over. But we've already started Madison and Bear Creek's CapEx, gathering a ton of bids and completing some exterior projects, some lender required repairs. But getting going there, and we look forward to beginning our interior package as well, but gathering bids there. We do have a acquisition scheduled for about 3 weeks, 2 or 3 weeks from now. So it's March. And this is actually a goal that we've had on our list for a long time, to get into Dallas. And so it's a smaller property, 1980 vintage, but it's our first foray into the Dallas-Fort Worth area, and looking forward to many more. And then also just this quarter, we hired a asset management virtual assistant, and we're also hiring a new analyst to help as we scale up operations. Goals wise for the year, we're looking to increase from our goal last year was 250, and we were slightly under that at 225. But looking to do 350 million worth of transactions this year, or acquisitions. And currently we're under contract already for 137 million. Not at liberty to divulge about the properties other than this. But again, this is a smaller deal, so the other ones are on the larger side. But those should be, your information should be coming out soon. And then, really just looking to see what happens with the interest rates, the Fed. We've spoken with other sponsors and just other investors, and heard that some sponsors have had to make capital calls due to the interest rates and floating rate debt. Fortunately, we haven't had to do that, and we've been looking at a number of different strategies just to bolster our cash reserves. We are looking to refi a number of our loans just to alleviate the into fixed rate, which might seem counterintuitive, but for some properties we're out of IO, and so we get fresh IO. But just looking to not have to deal with a few different things, rate caps, which have gotten increasingly expensive, but also, like I mentioned earlier, the draw process and CapEx holdbacks. So, looking to just find ways to make our cash flows more stable and consistent, and ultimately distributions to investors stable and consistent and increasing. So that's really all I have. It's 2:30 on the dot. If anyone has questions, feel free to send them to me directly. My email is josh@lscre.com. Same as if you have Rob's, it's same thing, but mine is Josh. I'm just not as great a multitasker, so I haven't been monitoring if there have been any questions, but yeah, otherwise we'll have another Q1 2023 portfolio analysis in a quarter. Rob will be back, and I look forward to sharing updates with you then. But I hope everyone has an amazing day, and thank you all for attending.